Brian Beaulieu, good afternoon.
Good afternoon, David. How you doing?
I'm doing great. Thank you for asking. So I'm actually really excited to talk because I understand you're an economist, and I think that understanding economics, particularly the macroeconomic landscape of what we're dealing with, is highly underrated in all of real estate investing. In my opinion, we tend to focus way too much on the deal, which turns into the inspection report, which turns into line item 3A. And the next thing you know, you think you're buying a crack with a house around it instead of a house that might have a crack in the plaster. So I always encourage people to widen your perspective and look bigger. So I'm excited to talk to you today. If you don't mind, I'd like to just get right into it. What is your opinion on what the Fed's doing, what this presidential administration is doing, and how that's going to have an impact on the world of real estate investing?
You have to divide that up into a timeline. In the short term, what the Fed is doing is keeping interest rates very low. The bond market's being very accommodative in that regard. Also, really, Chairman Powell and the rest of the Fed is accommodating the government's desire to engage in a lot of deficit spending and really add into the national debt. So it's not coming around to hurt us right now because the Fed is accommodative. And that's good. We see interest rates staying low for, well, not becoming a problem until we're deeper into 2023, maybe even 24. So for our space, that's really good news. Interest rates staying low are going to help our values. They're going to help keep the economy rolling, keep our occupancy high. All of that's really good news. Down the road, and that's why I said we needed to separate it a little bit, is all this deficit spending leads to a weaker U.S. dollar, which leads to higher inflation, which leads to higher interest rates, which isn't so good for our industry. So this side of 2026, I love what's going on. The second half of this decade, you're going to have to be a lot more circumspect about where you are buying, as opposed to right now you have a rising tide that's going to pretty much float all boats.
So if I understand you correctly, your overall opinion would be the policy that the Fed and the sort of the Biden administration is putting into place is that we want to keep the economy as healthy as we can. We're going to be printing more money. We're going to be raising the debt ceiling. We're going to keep interest rates low to make things more affordable. In the future, in order to reverse some of that, they will have to raise interest rates, which would be worse for investors. Is that more or less?
No, I don't think they're going to have to raise interest rates. And that suggests that it will be initiated by them. I think the bond market, which is bigger than the Federal Reserve, is going to demand higher interest rates. It's fairly classic economics, and I'll show it later on today. As a matter of fact, all this deficit spending ends up being a drag on the economy. Think about it. If the deficit spending is for hard infrastructure, which is part of what they're proposing right now, that actually adds to GDP, that stimulates the economy, it'll get you some added growth. But when 3/4 of what they're talking about is for soft investment on people, it makes us a kinder, gentler nation. It doesn't get you any more GDP.
Right.
So you're adding a lot of debt without any growth coming from it. And that's eventually going to come back to haunt us.
So from an ROI perspective that's only looking at finances, it's not a great investment. The investing in like the soft stuff, the people that you were describing.
No, it's not. Sorry, I'm an economist.
That's what we're here for.
If I had somebody here who liked people or cared about people more, I guess I'd give you a different answer.
Well, it just depends on how you measure ROI, right? You're getting a return on your investment if that's what you're looking at. But if we're only talking about finances and economics right now, it wouldn't make a lot of sense.
And for real estate investors, I mean, that's what they have to look at long term.
Right.
I mean, the other soft ROI isn't going to get them what they want at the end of the day.
So do you have any predictions for what you think we're going to see on the other end of 2025 or 2026?
Yeah, there's a recession coming for 2026, primarily financially driven. It will impact our space, but not catastrophically. It'll be more like a reset, a correction in some of the trends. And we see a whole lot of inflation out there post-2025. And our markets tend to do well during periods of inflation, even with the higher interest rates. We can carry those higher interest rates for a while. So I'm really not anything but bullish on our space through the rest of this decade, really.
So if we can lock in low interest rates right now, and then the properties that we buy right now are only going to appreciate that much more with inflation, that's a win-win, right?
Lock and load.
And that's very similar to the position I find myself in. I think this is one of the best times ever to invest. Not necessarily for any reason other than there's a shortage of supply and they're printing so much money that prices sort of have to go up. There's almost no way around it, right?
So often, David, you probably get the same thing. I'm position, well, should I wait for these prices to come down before I buy? And I said, no, they're not going to get any cheaper than they are today by 2026. And you're going to lose all that appreciation in cash flow between now and then. Now's the time to make you move.
I appreciate you saying that, because that is why I was asking these questions, is all of our audience is asking, should I wait for the recession? Yeah. And here's a point I want to run by you and just get your opinion on how you see it. One of the things that I think will happen is, let's say you have a property worth $1 million right now and you're waiting for the recession before you buy. Well, if it goes from 1 million to 1.5 million, and then it drops all the way to 1.25 million, you can wait to buy the dip, but you're still spending $250,000 more than now. Is that similar?
That's exactly right. And you'll be paying a higher interest rate on it.
Yeah, that's a great point. Also. Yeah. And you'll have that much less experience of how to manage that property, how to stabilize it if you wait till then. So I think there are times where timing the market, buying the dips does make sense. I don't know that this is the market that makes sense in now. I'm actually seeing there's so much competition for houses. If you can get something, it makes sense to get it.
You're absolutely right. And people need to keep in mind, this is that macroeconomic perspective you're talking about. The balance sheets in corporate America today, amongst people, not corporations, but our balance sheets, they're healthy. It's not like 2005, 2006. If people have that paradigm in their head, they get the wrong thinking going on.
That is such a great point, because I think when people see the strength of the market, how hot it is, it's easy to make the jump that, oh yeah, 2005 felt just like this. Therefore, a crash must be coming like in 2005. Right. But the 2005 crash happened because of bad lending practices, right? People were getting loans that they could not afford in order to help them buy a house, because we were pushing home ownership on everybody. I have a mortgage business now as well as a real estate business, and I don't see anyone getting loans that they can't afford to pay.
Oh, heck no. In fact, I find that, and you see the numbers too, there's more cash involved than before.
That's exactly right.
These are much more sane levels of loan activity going on.
Yeah, and if you consider how strong our economy has been, albeit maybe from artificial reasons, as we've had a lot of stimulus that's not normal, right? There's a lot of 1031s going on. There's a lot of IPOs, like where I live in Silicon Valley, where people have just become flush with cash and they have to find somewhere to put it. Real estate's one of the safest and easiest places to stick a whole bunch of cash.
Especially given, and I'll be talking about this, how the stock market is fundamentally overvalued. So you can go into a very risky asset that has been flying high and doesn't do well during a period of inflation, or you can go to this rock solid asset class that does well during a period of inflation. To me, it's a great time to be in real estate.
Yeah, but there's a lot of competition. Right? That's just one of the reasons that our market is so strong, that everybody kind of wants a piece of it right now.
Which is why you don't want to delay.
That's exactly right.
You find that deal, you strike.
So what advice do you have for the people who hear this and they think, man, I was waiting for a crash, I think I see the light, it's not going to happen. Where should they start?
I get on the horn this afternoon and start throwing out some deals.
That is awesome. Any markets that you like more than any others in our country?
Oh, definitely. I always go where the demographics are really strong. So that can range from Texas in general to Nashville, Tennessee specifically. And I always stay away from the states that have a negative demographic trend. So as much as I love West Virginia, the demographics there are negative, right? So you got to be very, very careful. In Illinois, Vermont, New York, Rhode Island, they all have negative, people are leaving those states.
I see.
You go where there's going to be more demand in the future, not less demand as people leave.
That's a great, great piece of advice there. Anything else you want to leave our listeners with?
The world isn't as crazy as it looks at first glance. We've been here before. Been there, done that, bought the T-shirt. You just got to know enough history to know that we're okay. We're going to be fine.
I love that. Don't make Don't make decisions based on your emotions. You can think these things through, and you can make objective decisions with a lot of this information. So thank you very much for sharing this.
My pleasure. Thank you.